Kumba Iron Ore came out with interim results earlier today, with headline earnings per share up 40% to just over 28 Rand. Eleni Giokos caught up with the company's CEO, Griffith.
Yeah, we're very proud of the performance from Kumba again this half year. So as you mentioned, the headline earnings up by 40%. So that's coming from a great set of production results. Now, although the production was seriously affected by the more than 3 times the annual rainfall over the period, so production results themselves were down, but because we were able to supplement our production with stockpiles from the mine, meant that we actually had a really good sales performance. So it was actually on par with what we had last year. So the sales performance was good. In addition to that, we had record iron ore prices up 56% year on year, and as a result of a good sales performance, which we were able to supplement the production from stock, and then adding that to the great prices, meant that we had phenomenal revenue into the company, and that's why you saw the massive increase in headline earnings and profit.
Well, production only down slightly, and as you mentioned, the rainfall has been a very big hindrance. Going forward, obviously there needs to be plans to try and rebuild the stockpiles. What strategy have you put in place to replenish those stocks?
Yeah, I think first of all we've got to produce so that we can sell. We did have a much better second quarter than the first quarter. So our second quarter, notwithstanding the fact that even in the second quarter we had very abnormal rainfalls, meant that we were up 18% in our second quarter versus our first quarter. So we think we had a really good performance. We need to continue that kind of performance into the second half. And as long as we keep on increasing our production, we'll produce enough so that we can sell, first of all, and then if there's in excess production, then we'll replenish stock.
Okay, so we're looking at operating margins, as I mentioned, of around 70% from around 63% the previous period. A lot of investors out there that I've spoken to say, well, are these numbers sustainable? How long can you sustain these kind of levels for?
I don't think any business should expect to have a 70% margin forever. So at the moment, the 70% margin is absolutely fantastic. So great set of results. But, so they may come down a bit, but it's still a very high margin business. And even at very long-term prices, where we do expect prices to come down, the fact is that this is still a high-margin business, and we think a great investment, a great company to invest in.
With regards to China and Chinese demand, we also know that iron ore prices have been, hitting the roof, basically. Where do you see that headed? Do you see China having a soft landing or a hard landing, or do you see it somewhere in between? Because this is the rhetoric that's come through.
Yeah. I don't think it's a hard or soft landing in China. The fact is that China is building, and that is continuing. So you're seeing this massive urbanization will continue to come. At some point in time, you can't have a 10% increase in GDP every year, but it's often increasingly higher and higher base every year. So at some point in time, of course, you will see China, their GDP in percentage growth terms coming down, but this is on a massively increased base. So we don't think that there's a landing anywhere. The fact is that it will, because you just can't keep growing like this forever, we see that China will continue to consume vast quantities of resources, and the resource companies that are selling into China will benefit. At some point in time, the extra production that will come on board will mean that the prices will come down. This is to be expected. And as I say, over the long term, you will see a price coming down. But I think most analysts are now starting to see that that long-term price is actually quite a lot higher than previously anticipated.
With regards to new contracts and obviously renewal of contracts, what kind of numbers and levels are you seeing coming to the table? Are you still seeing it at elevated levels, or are you starting to see a bit of softness coming through?
We could enter into more contracts if we had more ore. So at the moment we sell around about 85% of our volume to our long-term customers, and they would take more ore if we had more ore. So as we see Kolomela coming on board, we already have that ore, expressions of interest for that ore. So we're not concerned about not being able to sell our ore.
Okay, Kolomela is a very exciting project, and we know that you are basically on target with regards to completion. Tell us about the impact that Kolomela is going to have, and you were saying that if you've got more, you would definitely embark on selling more to new customers.
Yeah, Kolomela is very exciting. We think it's one of the few projects worldwide that has delivered on its promise to come in on the time that we told the market. So we've always said that halfway through next year we would start producing, that we would do more than half of the production next year, even though we've only come on board halfway through next year. And the fact is that we, in all likelihood, will be under budget. So we think it's a great story. We already have some of the ore that's now in front of the plant. We are hot commissioning that plant in the second half of this year. So at this point in time, everything seems on track and on budget, and perhaps a little bit ahead of time and perhaps a little bit under budget.
And of course, as you said, we are expecting continued demand coming through, and the key factor there is that China continues to urbanize. Looking at Japan and Japanese demand, because that was relatively flat over the period, you're also expecting some kind of increase in demand from that region. So clearly, we're seeing a lot of positivity for the future. Is that the right assumption?
Yes, I think that's correct. Even though that Japan had the tsunami and the earthquake, their production has still been flat on 2010. So as they start rebuilding the damaged areas, we expect to see some increase. So we do see very good news story in Japan. We see a very good news story in Korea, and then Europe itself has been up, 7% on the second half of last year. So all round in our traditional markets, that's doing very well, and then China, that's increased, 7 to 8% up on crude steel production. It looks like another good year for steel production in the world.
Tell us about your customer mix at this point in time and whether it's changed over the past few years.
Our customer mix is still the same. In this half year, you've seen that we sold more than we normally sell, about 60% to China. We sold 69% to China, and then the other two markets, of course, came down a bit. Not because we didn't sell to them. Japan came down a bit, but it's because we've actually got quite a number of shipments that have actually just gone from the first half into the second. So our customer base stays the same. We still plan to have about 60% to China, 20% to Europe, 20% to Japan and Korea.
We're talking about profit margins being at 70%. Cash costs, though, are up 18%. We know that the very big contributor there, diesel costs and the likes of electricity, and also the fact that labor is becoming far more expensive. You're talking about cost management. How do you plan to do this going forward? Do you think we've hit a ceiling with the cash costs at 18%, or do you think that we could actually see a bit of an increase?
Yeah, I think it's very important to realize that we have guided this year to about a 20% increase in cash cost. The majority of that is actually coming from the additional waste that we're mining. And then in addition to the normal inflation, you are seeing the factors that you've commented on, and that's higher labor costs, higher diesel costs. Diesel went up from 7.90 to about 8.80 a litre, so very significant. We use massive amounts of diesel. So you will see above inflation costs, but the majority of our costs are coming from a planned increase in waste stripping so that we can secure the future of the mine.